A very good morning to everyone. It's 7:35 and now we will start today's.
Hello. Hello.
Yeah. Vijaya, can you mute Mr. Subhajit? Vijaya? Yeah. A very warm welcome to each one of you. Today's topic is really intriguing for me. All of us are aware about contingent assets and liabilities, but now we are going to hear about contingent consideration. I'm interested and eager to listen to you, Bharti. And one announcement I would like to make. As all of you are aware, December 15th and 16th, Bangalore Valuers Association, in association with IAV RVF, has organized a 2-day session at Royal Orchids, Jakur in Bangalore. It's near airport. So I appeal to everyone to please register as very few seats are left. Now I request Mr. Shiv Prasad, Secretary, Bangalore Valuers Association, to formally introduce today's speaker to all of us.
Good morning, all. I welcome you all to the unique presentation of Ms. Bharathi Bojamma, who is a Master of Commerce, Chartered Accountant, and an experienced valuer. She brings a wealth of experience to the table. This seasoned Chartered Accountant holds a Master degree of Commerce. With 2 years of post-qualification experience, she specializes in valuations and major M&A deals with dynamic IT and ITES service sectors, currently contributing her knowledge to Unithouse Valuation and Deal Advisory Division. She is well equipped with to evaluate business to new heights. Actually, this is a very new and unique topic which everybody is eager to gain knowledge from her wealth of experience, and we look forward for her coverage on the subject, this unique subject. I welcome you, Ms. Bharti, into this webinar, and we request you to take over the session and enrich us with your knowledge. Thank you.
Thank you so much, Shiv Prasad. I would like to take this opportunity to thank Ms. Shilpa, the President of BVA, the Secretary, Mr. Shiv Prasad, Vijayalakshmi for organizing this, and Mr. Ravi, who invited me to present on this topic. So it's an immense opportunity for me to present here. And I would like to extend my thank you to all the BVA and non-BVA members who are present here as well. So. The topic that I've chosen today is the valuations of contingent consideration, also called as the earnout. So the scope would be to discuss the nuances from a valuer's perspective here. So before we jump into the discussion on the valuations of contingent consideration, I would want to take you all through the content of discussion today. So the content of discussion is going to be the introduction. What is contingent consideration or earnout according to the Ind AS 3 or IFRS 3 and Ind AS 103? How often is contingent consideration being part of an M&A transaction? What is the treatment of the earnout when it is linked to an employment, whether it is to be treated as a contingent consideration or the employee remuneration? What are the underlying metrics that can be used to structure the earnout transactions? What are the characteristics that are involved in the payout structure? I will touch upon the basics of the valuations method. There are two valuations method, which is the scenario-based method and option pricing method. And then finally, we will discuss on, after discussing all the metrics and payment structure, what should be the criteria for selection of valuation methodology. So this would be the content. So I would proceed to the introduction now. So the introduction of contingent consideration. So as you all know, contingent consideration is an obligation of the acquirer to make an additional payment, or it could be in the form of assets, it could be in the form of equity interest, in order to acquire the balance portion of the shares that is there with the acquiring. Okay, so contingent consideration included in the business combination must be measured at a fair value as on the acquisition date. This is as per the Ind AS 103. And I would request, in case if anybody has a doubt in between the sessions, please go ahead and ask, so that everybody gets a clarity on the topic as such. Next, how often is contingent consideration as a part of purchase consideration? If you can look at the figures, this is a study that is conducted by Polygon Lockheed, which is a famous, investment bankers. According to them, almost 20 to 25% of the transaction consists of contingent consideration. The highest would be the healthcare sector, which almost records 45% of their PC includes a contingent consideration as a payment. Now, next, when we say contingent consideration, there are cases where contingent considerations are sometimes linked to the employment. Now, this is a question that I want to ask the audience here. In case if there is a continuous employment, that is when there is a founder, the company acquires the company and takes the founder on board. He is in continuing employment, and there is a earnout payment which is linked to the employment, whether it will be treated as a contingent consideration or not. Anybody would want to answer? Okay, so let me continue then. So when a founder is onboarded for the continuing employment, and in case if the earnout is linked to, let's say, the employment, and on termination of that employee or the founder from the employment terminates, automatically forfeits that earnout, right? So that is not considered as a contingent consideration, because it will be directly linked to his employment and it will be treated as a post compensation expenses. Okay, so next is continuing employment, but there is no automatic forfeiture. Let's say the founder onboards on the company, but on his resignation from the employment, that earnout still continues to be paid to the employee, which is the founder. Then it will be treated as a contingent consideration in that case, because we can assume that that is not directly linked to his employment as such. Next, the duration of continuing employment. Correct. So let's say the founder is onboarded and he is in employment and he's paid the earnout payment, right? So that earnout payment is for the let's say the earnout period, or if it is longer period, right, then it can be treated as a contingent consideration again. If it's for a shorter duration of time, then it won't be considered as a contingent consideration. It will be treated as a post remuneration expenses. Anybody, any doubts so far?
Actually, can you summarize it, because I felt a little confused.
Sure. So what I'm trying to say is that, let's say there is a company A, okay, that acquires a company B, and there are, let's say, 3 founders there. So after acquisition, what the company A will do, they will say that you continue as an employee with us. There is a certain portion of remuneration that is pending to be paid. Let's say that 90% is acquired, 10% is still with the founders, and they onboard them as an employee, correct? So let's say they have structured an earnout payment where they say every year, based on whatever criteria, I will discuss about the criteria later, I will pay you certain sum of money every year. Suppose on resignation of that employee, right, there is an employment contract that is done. If the employment contract gets terminated and that earnout payment is also getting terminated because of that, there is an automatic forfeiture. Correct. That means it's linked to the employment of the founder. Because he's there in employment, I'm going to pay him that money so that he will stay with me as a part of remuneration. It not necessarily be a consideration that is paid for the balance sheet. So that is why the payment that is paid, the amount that is paid to the continuing employment, where automatic forfeiture is there, will not be treated as a contingent consideration. Instead, it will be treated as a remuneration that is paid. So similarly, in case if there is a continuing employment, but the earnout that you paid, you promised that you'll pay X number of money for every year, right? It gets forfeited. it doesn't get forfeited. The employment agreement gets forfeited, but the payment doesn't get forfeited. That means it's not linked to the employment as such. It is paid to the employer for the balance share consideration. So we will treat it as a contingent consideration in that case. So continuing, in case of duration of employment, if it is the period, whatever is the earnout period is there, right? It is equal or is longer than earnout payment period, then the earnout may be compensation in that case. For example, let's say earnout period is a 3 years. Okay, so I will say to the founder that I will make you X number of payment for 10 years. So it is not necessarily linked to the payment that is given to the founder for his shares. It would necessarily be for the employment that is going to give for 10 years. So in case of duration is either shorter or I would say closer or more than the earnout period, then it will be treated as compensation. In case if it is lesser, then it will be treated as contingent consideration. Any questions so far?
You can proceed.
Sure. So the level of remuneration, let's say there are, other employees with the similar statute. For example, the founder is offered a CEO position. There is a co-CEO as well. So in case if the earnout is more or less equal to the salary that is paid to the co-CEO, that will be treated again as a remuneration because it is a market participant remuneration that you are paying to the founder in the form of earnout. So that will be treated as a compensation. In case if it is little bit more, let's say the non-CEO is paid little lesser than the CEO, which onboards as, founder is onboarded as a CEO. In that case, whatever difference is there will be treated as a contingent consideration. Next, incremental payment to the employees. What happens here is, let's say, this is one more example that I gave. Suppose there are 3-4 founders, right? So in case if the every founder all the founders are employed as an employee and there is a difference in payment to each of the employees, right? Then that means it's not at a market participant point of view. Whatever difference is there will be treated as again the contingent consideration. Whatever is paid equally to everybody will be treated as a remuneration in this case as well. Next is number of shares owned. Let's say the founder is owning the majority shares in the company and he gets onboarded along with an employee. In case if the founder is paid a remuneration, if he's paid a earnout, it will be treated as a remuneration in this case. Suppose if he was a minority shareholder and he comes on board and along with other founder, let's say he's paid earnout as well. In that case, he will be it will be treated as a contingent consideration.
Can I ask a question?
Sure, please go ahead.
No, are we saying broadly that any payment we are linking it to a company's outflow, whether paid now or later?
Correct.
At a market determined for an individual, that is considered, and if you are paying later, that amount is contingent consideration. Any payment.
Correct. Please go on.
And any payment made to individuals, which is nothing linked to the company, then that is not part of contingent consideration. Is that understanding correctly?
Not necessarily. Let's say an example. There is a outflow from the company plus in case if he is in the capacity of employment and doing that work and getting that earnout for the solely in capacity of employment, right? That can be treated as remuneration as well.
Yeah, so that is outside the company. So see, when we are purchasing the company, the payments are made to the shareholders of that company or whosoever it is.
Correct.
It could be a creditor. So any payment made towards the company, whether paid now or later, the amount paid later is the contingent consideration if it is based on certain criteria. Any payment made to any other stakeholders, which is independent of the company, by they participating inside the company or they're not participating inside the company. But then that is not contingent consideration. Is that how can we summarize?
That is also a contingent consideration, right? Let's say there is a founder who doesn't come on board, but the company promises to him that, let's say, on reaching so much of EBITDA, if the company performs well and there is an EBITDA, that is coming in, let's say 10% increase in EBITDA, I will pay you so much. That will also be treated as contingent consideration.
Yeah, but that is towards the company, because founder was a shareholder, and to that extent it was agreed upon to pay, and
Correct.
therefore it is being paid. So the reason is that the original negotiation between the company and all the stakeholders of the company, when you're negotiating it either to pay upfront or on various terms and
Correct,
conditions. Correct, right?
Correct,
So and the conditions of employment or such other things which is not linked to the company's acquisition, those are not contingent consideration. Is that a fair way to look at it?
Yes. It would be a fair way. And again, we need to check if there is any certain condition attached to it. Suppose if there is no condition attached, it again can be deferred consideration versus the contingent consideration.
Thank you so much. Okay.
Shall we move?
Yeah. Thank you.
Thank you. So when the characteristics of contingent consideration is very important to look at from the valuer's point of view. So when I say the characteristics, there are three characteristics underlying a contingent consideration. First is the underlying metric. Based on what? Whether it is a financial metric or non-financial milestone based event that we are structuring. Second is the payoff structure. What is the way that we are structuring a particular transaction? So third is a settlement. Settlement is nothing but the cash, or you can pay it by the way of assets, etc. Right? So these are the three kind of characteristics that is very important to look at when we are determining what kind of methods to apply as such. So first metric of ours is an underlying metric, wherein we have two kind of metrics. First is the financial metric and non-financial milestone based event. Correct. So first is a financial metric, wherein let's say the earnout is linked to revenue. You achieve so much of revenue, I will pay you so much. So that could be one of the financial metric that is tied to the earnout payment. Second is EBITDA. There could be the earnout could be tied up to the net income or business metrics such as number of units sold or rental occupancies, etc. Non-financial milestone based event, this could be significantly seen in case of healthcare and life science or bioscience companies, wherein let's say there is an acquisition of bioscience companies and you say that the FDA approval is required, then only I'll pay you so much amount. So that is one of the example of non-financial milestone event. So the things that will come under non-financial milestone event will be regulatory approvals. There are some resolution of legal disputes that are supposed to be done. There is execution of certain commercial contracts or retention of the customers. There is closing of future transactions. Suppose you have already entered into a contract and that contract needs to be closed for you to get the payment. Achievement of technical milestone. For example, there is a product launch. This could be significantly seen in case of startups where the product market fitment is not yet done. A stage of product development or certain software integration tasks or construction project. So these are the two metrics based on which your earnout could be structured. Next, moving on to the payoff structure. What are the kind of structure that we can bring in the contingent consideration? And in each of the structure, we will discuss what are the metrics which are there, whether it is financial or non-financial metrics, and based on the payoff structure, whether it is linear or non-linear, our method of choosing evaluations will depend on.
Bharti, just a minute. There is a question in the chat. Okay. Basically, the participant also wants to know, rather even I want to know, where and what is the genesis of knowing this? Like, is it part of just 1-2 minutes you can throw light so that, people will understand the context?
Absolutely. So thank you, Debashis, for raising this point. So we are discussing contingent consideration. The main purpose of this is that this does part a form of purchase consideration. See, from accounting point of view, if you ask me, I am not an accounting expert. If somebody is there, maybe they can throw more light upon this. According to me, there are two kind of accounting we have seen so far in, when we are dealing with such kind of transactions. First is, the audit team can take a view that they want to include this as a part of the purchase consideration and ultimately will go to the goodwill. Second view is also taken wherein this is in case if there is a call or put liability, they could record this as a separate. They can take a grossing up method, which is the typical NCI method, take the gross up figure, and whatever you get as a value from valuations of contingent consideration could be recorded as a liability in the books of account, and whatever on each of the measuring date they can revalue the same, and whatever difference is there can be routed to profit and loss. So this is two kind of accounting that we do. So based on whatever is the audit call that is taken, you can decide on whether to include this in purchase consideration or not. But nonetheless, in PPA allocations, when you're doing, you have to value the contingent consideration, because after according to Ind AS 103, you have to fair value the contingent consideration and take it either in your PC or as a separate item in the financials. Hope this clarifies.
Yes, thank you.
Yeah, thank you. So next is the payoff structure. So
Sorry,
what are the kind?
Bharathi, that means what you are saying is this is used whenever there is a merger or acquisition, is it?
That's correct. That's correct. So whenever, so maybe just to clarify, so let's say there is a mergers and acquisition event that happens, right? So there are three kind of structuring that they can do. First is the upfront payment, be it in cash or be it in shares. They can settle in cash or shares. Second is a deferred. Let's say they don't have a money right now, or they have certain conditions subsequent that is supposed to be satisfied, post which the consideration is supposed to be made, which is called as ideally the deferred consideration. And there could be certain events wherein the from buy side point of view, I want to let's say hedge my risk. Specifically, if you look at the startups where there is a no revenue establishment, or there is no proper EBITDA as such in place. So what we do is that in order to hedge our risk from overpaying, we come to a conclusion. If we are not able to decide on the price, we say, okay, you meet this condition, I pay you so much. What is the advantage for the seller? He could also get an upside in the EBITDA that the company is making, right? So both the ways, it's a win-win situation where both the parties are not able to, let's say, decide on particular price. They can structure something called as a contingent consideration, where they can look at the, depending on the payment structure we are going to discuss, they can decide whichever is beneficial to both the parties and go ahead. So there are three kinds of PC. One is the upfront payment, second is the deferred consideration, third is the contingent consideration. And we are talking about contingent consideration today.
Bharathi, just one summarizing. Yeah, we have understood everything. Only thing is, all of this is done purely on accounting on a particular day to understand whether it is a liability or a contingent liability or re-evaluation of the contingent liability.
It is done on the acquisition date. So when you acquire a company, you do a exercise called as purchase price allocation as per Ind AS 103. So that is when you have to see what is the PC amount for you. And at the same time, the company acquirer has to, there is a payment that will come in the future. They have to make, necessary adjustment in their financials to record that, right? There is a certainty of this payment. So that is the reason we fair value the contingent consideration. The fair value of contingent consideration could be zero as well, correct? Depending upon the, certain factors. But as on acquisition date, they are supposed to carry out this exercise and see what is the value of contingent consideration, and then decide what treatment they want to do it in the books of accounts. And in case if they decide to take it as a liability in the balance sheet, right, then they will have to fair value it in case of a listed company, quarterly fair valuation, in case of a unlisted company based on yearly, books closure.
So this should form a part of the scheme, is it?
Scheme in the sense?
Whenever there is an acquisition or something, there is a scheme is where both the parties, acquirer and acquiree, are entering.
Mm-hmm.
So this should be.
It will be part of the structure itself. Let's say there is a company that enters into transaction, right? So they could decide that, let's say 50% I pay you by cash, 30% let's make a deferred payment, and on 20 balance 20% they could agree that in future I will make payment, but on satisfaction this condition. It will all be part of your transaction itself.
Transaction. Okay, thank you.
Okay.
So according to you, in the balance sheet, entire 100% is shown. Out of 100%, what you pay upfront is taken care of. Correct. The remaining is shown as a liability towards payment. And because you require a fair valuation of assets and liability for Ind AS valuations, then you keep doing fair valuation every time. Correct. One which is deferred but certainty to be paid, anyhow that gets fair value to the amount what it is.
Correct.
The one which is deferred and contingent upon certain thing, that's contingent outflow. And given it is contingent outflow, when you do a fair valuation, suppose if that is essentially based on achieving certain numbers, someone does a valuation whether it's possible, not possible, and you keep readjusting that liability.
Correct.
Is that something? Is it more for India's valuations?
That's correct. Yeah.
Thank you.
Thank you. Should we move? Anybody has a question?
Please go ahead.
Sure. So next, moving on to the payoff structure, what are the kind of structures the companies could come up with in order to settle the earnout payment? So first structure is the milestone payment, also called as the digital or binary options. So what happens here is that you are going to pay the person on satisfaction of certain milestone. I gave you the example of a let's say healthcare or life science or bioscience company, wherein they are supposed to require a FDA approval. On FDA approval, I'll pay. This is also, I would say, a kind of deferred consideration, because there is just because there is a milestone to be achieved, I would say this will fall under a contingent consideration as such per se. Okay. So if you see I've given an example here. The company ABC is acquiring company XYZ. So they have agreed that they will pay 10 million to the company XYZ upon successful completion of the acquisition. They have made a milestone payment also in the SPA, saying an additional USD 5 million will be paid as a contingent consideration if and only if company XYZ obtains FDA approval for its Cree product within 12 months after the acquisition date. So in this case, if the FDA approval is obtained, let's say, okay, within the specified time frame, the company ABC will make the payment of additional 5 million. In this case, your PC will become 15 million. So in case if the company is probable that it will take an FDA approval, right? Today we can recognize the PC at 15 million. Next, if the FDA approval is not obtained within the specified period, no payment will be done by the company ABC. The RPC will be limited to USD 10 million. So this is also an example of non-financial milestone, which is a diversifiable risk. It is not per se not linked to any market related risk. It is only related to whether you get an FDA approval or not. Should we move?
Yes,
I have one
please.
question here.
Sure.
So what all documents do we need at the time of taking this assignment? Like what is there in the checklist? Whether we also need the structuring documents?
Necessarily all kind of structuring will be done in the SPA. If you see the SPA or BTA or SSPA, right? So in case if you take any documents, they would ideally give all the structures in the SPA itself. So that should be enough for you to conduct this assignments.
Okay, so for evaluating this particular contingent liability, only SPA is required.
That's enough. Yeah. If you read out the document, you will know that, ideally what should be the condition is that how are they repaying that 100% of the shares, right? So it could be that they are paying 50% by cash and 50% by this. They will also agree upon what will happen to the balance shares. That could be in the form of contingent consideration.
And this will be ready by acquisition date?
Yeah. Because not acquisition date. Ideally, the PPA is done after acquisition, right? So for the acquisition date, for the year ending is what we do.
Okay, got it.
So there is 1 year for you to do a PPA allocation. So you can do it within 1 year, and by that time SPA should be available.
1 year from acquisition date?
That's correct, yeah.
Okay, thanks.
Should we move?
Yeah, please.
So next structure is a payoff structure number 2, which is linear. So what happens here is your earnout payment is proportionately, linked to your financial metric. Let's say the EBITDA increases at so and so percentage over the year. I'll get so much percentage of EBITDA as an earnout. So to just simplify, I have given a scenario here. Company A will be required to pay 30% to the acquiree in case EBITDA earned over the subsequent 1 year period. The payment is due in 3 months after the end of the period. So if you see here, the probability is that the management has given a probability that 1,500, the EBITDA being 1,500 is only 25%, 2,000 will be 50%, and 2,500 will be, just a second. Okay, will be 25%, right? So we can take a probability weighted future earnout model here, which is also simply called as the SBM model, right? Scenario based model, and we can arrive at the value that is supposed to be paid as a contingent consideration. To simply explain the structure, this is nothing but a structure wherein with the EBITDA your earnout can increase. For example, your EBITDA is 2,000 this year, 30% of that will be paid as an earnout to you. Next year it is 2,500, 30% of that will be paid as an earnout to you. Next year it is 3,000, it will be 30% of that will be paid as an earnout to you. So the structure is linear here, where it's proportional with the earnings that you make. This is an example of financial metric. So moving on, percentage of total above a threshold. This is also called as asset or nothing call option. So here, what would be the condition is that, let's say there is a metric that is supposed to be achieved. Let's say acquirer puts a condition that in case if the EBITDA exceeds 2,000, up to EBITDA being 2,000, you will not be paid any amount. But in case if the EBITDA is exceeding above 2,000, right, you will be paid 30% of the annual EBITDA, which will be full percentage of the underlying metric. For example, it's 2,500, 2,500 into 30% will be paid as a earnout to you. So this is called as the percentage of total above threshold. Okay, so in this example, the payment will be triggered only if the annual EBITDA of the acquiree exceeds a specified threshold of 2,000. If the EBITDA is below 2,000, no payment is required. Payment is equal to percentage of the underlying metric, but only if the performance threshold is reached. That's why it's called as asset or nothing call option. Next, we have a fourth method, which is also called as excess above a threshold with a cap, also called as capped call option. So what happens here is a company will pay 30% of excess of the acquirer's annual EBITDA over the subsequent period, but there is a cap to it. Okay, so this is nothing but same as a percentage of total above threshold method only, but in this case there is a cap that is there. Let's say the payment comes to, let's say, 500, but the cap is there of 300, so they'll be maximum eligible for 300 as a earnout payment. So in this case, the payment will be triggered only if the annual EBITDA of the acquiree exceeds the threshold of 2,000. If the EBITDA is below 2,000, no payment will be required. The payment is calculated 30% of the amount by which EBITDA exceeds the threshold, and cap on payment is there. There is a cap on the payment structure. Maximum payout that the company is obliged to make is capped at 300. Next, excess above threshold, also called as call option. Here, the payment will be done only if the EBITDA is above 2,000. But what is the difference between excess above threshold and percentage of total above threshold? Is the difference is that in this case you will be paying on the total EBITDA. Let's say 2,500 is the EBITDA. It has exceeded, right? 2,500 is the EBITDA. In that case, 30% of 2,500 will be paid as an EBITDA, as an earnout. But in this case, excess above threshold, which is a call option case, only the excess portion will be eligible for an earnout payment. Let's say 2,000 they make, that is already factored in the payment that you have already made, let's say in the form of cash or deferred payment. Only excess which you are paying, let's say excess you are making, let's say 2,500 you make, on 500 you will be eligible for a 30% of the excess payment. This is called as excess above threshold method. Any questions?
Bharathi, this is like how we are going to value this is something which I understood all the scenarios. But then how do we actually value it
Sure, Shilpa. I'll come to it. Once we finish all the metrics, right? So based on the metrics and the the metrics and the payoff structure, we can decide on which method to choose to value, which kind of consideration.
Yes.
So I'll come to it. Should we move?
Please go ahead.
Thank you. So next option is a clawback, or called as put option as well, wherein in case if there is a shortfall in EBITDA, let's say there is a company that makes a shortfall or the negative EBITDA is there after the takeover, in that case they have to protect themselves, right? So they could put this clause also in the SPA saying there is a clawback, wherein in case if the shortfall of the acquiree's EBITDA is below 2000, then the seller is supposed to make, or I would say seller is rather supposed to refund the amount that is paid to him. Let's say 30% of the shortfall of the EBITDA he will be supposed to repay to the company. So this is called as the clawback method, or also called as the put option method. Now, what is the approach for a contingent consideration valuation? So the three generally accepted valuations method, I think everybody is aware of, is an income approach, market approach, and cost approach. But commonly used approach is an income approach, because there may not be a proper market multiple that is available. Cost cannot be determined because it is all linked to a contingent consideration. So income method is the most commonly used method for valuing a consideration. And among income method, there are two methods that are used. First is the scenario-based method. Second is an option pricing method. So under scenario-based method, the identification of set of outcomes, scenario for underlying metric. The metric would be, like we discussed, financial or non-financial metric, or the payoff associated with each outcome. Payoff is nothing but we discussed about linear, milestone-based, threshold-based. So depending upon what is the underlying metric and payoff associated with each outcome, we can decide on whether we should apply scenario-based method or option pricing method. So what happens in a scenario-based method is that the payoffs are then probability weighted average will be taken to the we will take a probability weighted average of the expected earnout, that expected cash flow. Let's say the financial metric is an EBITDA, etc. We will probability weight it, and then we will discount it at an appropriate rate in order to identify what is going to be the expected present value of the contingent consideration. Okay, next method is an OPM, which is again depending upon the risk that is there and payoff structure. We will use a OPM method. Under OPM, you can use the Monte Carlo. There is binomial. There is a Black-Scholes. Depending upon each of the structure and the risk associated, we can choose the appropriate method to be used. Although I think I've just given a brief intro about the structure. In case given an opportunity, I will take a brief about SBM and OPM model in the next session possible, because this standalone as an approach itself, it's a bigger approach to explain. So moving on to selecting a valuation methodology,
Can I ask a question?
Sure, please.
Is liquidation preferences in a structure a contingent consideration?
No, it is not, because liquidation structure is just an exit option in case of an event, right? It's triggered.
Yeah, so just like a payoffs, a payoff is basically a commitment to pay. Correct. But liquidation preferences is also in a similar form, wherein you determine indirectly a payoff based on a performance.
See, I would say earnout structure is essentially designed in order to, let's say, benefit both the parties, right? They can't decide, let's say, the liquidation. Nobody aims for a liquidation as such, right? So when does a contingent consideration come into picture or earnout comes into picture? When they decide upon some outcome. Let's say I will increase the EBITDA of the company increases, I'll pay you so much. Liquidation is just a risk mitigation, wherein in case if the company goes into liquidation, what is going to be the preference?
Sorry, when I said liquidation preferences, is essentially I invest in a structure of a CCD. Okay, and I state that while I am above others at this stage, whosoever has invested before me, while they would have invested in a similar kind of a CCD structure, my CCD structure is above others until an event or milestone is achieved in terms of the performance. That is what I'm considering. Maybe it should not be called a liquidation preference, I don't know. So here, even though my instruments are similar, but I am a later instrument has come. So my later instrument has a different kind of terms and conditions and priority over the earlier instruments. In such a scenario, is it a contingent consideration?
Let's see how this is structured, let's say, right? So as on acquisition, you're going to decide on how much of the consideration to be paid for 100%, right? So this liquidation preference you are giving, let's say you have issued CCPS. This is just a, what to say, it is a term of a CCPS that you have given. It is not contingent upon some event, right? For example, let's say there is a EBITDA achievement event which is supposed to happen. Now, for example, I onboard a founder. I am supposed to pay him certain extra amount in case if the certain conditions are satisfied. That is when the contingent consideration comes into picture. The valuation of CCPS is not something which comes under the ambit of contingent consideration.
Okay. Thank you.
Thank you.
Hi, Bharathi.
Yeah, hi.
To discount the contingent consideration, which type
Mhm.
of what rates we are taking and why?
Sure. So Mahesh, I would say in case if you're choosing an SBM model, and if it always depends on the risk that is associated with the payment that you're making, right? So let's say you are making a payment for a milestone-based payment, wherein the risk is just limited to the it's diversifiable risk is what I'm trying to say. It's not linked somewhere to the market. So in that case, you could take a cost of debt, which is if the contingent consideration is almost similar to that of a deferred kind of payment, then you can take a cost of debt. In case if there are risks associated, let's say EBITDA is there, achievement of EBITDA is always dependent on certain factors. Let's say there is a market factor, there's company specific factors, right? So in that case, you could choose to apply back.
Okay, what you are saying is if there is a only leverage risk, we can take cost of debt, right?
Correct.
Thank you. Okay, thank you.
Thank you. So how do we select a valuation methodology? So the two key difference between SBM and OPM model is that both the methods, the choosing between both the method depends upon the risk that is associated with the underlying metric and what is the payoff structure, right? So I've just made a decision tree here. In case if the underlying metric, let's say, is a non-financial event, for example, a milestone-based payment, right? Diversifiable risk. And in that cases, we can choose to apply the scenario-based method. If there is a financial metric which is a non-diversifiable risk, and if the payment is non-linear, it's not proportionate to the underlying metric, in that case we can use an option pricing model. In case if it is linear, directly linear to the payment you're making, you could choose to use an SBM model here.
Bharathi, here I would also like to explain us some examples of diversifiable and non-diversifiable and linear and non-linear.
Sure. You want me to explain, right?
Yeah, two examples. Yeah.
Sure. So let's say there is a milestone-based payment, right? FDA approval is required. For example, I gave you an example of first, kind of transaction here. So in this case, there is a milestone-based payment, which is a diversifiable risk. There is no market-related risk associated with this case. In this case, we could take a SBM model wherein we could apply the weighted average and probability-based weighted average, and we could estimate the value of contingent consideration. Let's say there is a complex model. Just to give you an example, let's say excess above threshold model is there. A company A is required to pay 30% of excess annual EBITDA above 2000. What is the probability of EBITDA crossing 2000 is not very, it's a variable event in this case, right? So here we can apply the method OPM. Any questions so far? Should we continue?
Yeah. And what is diversifiable and non-diversifiable risk?
So diversifiable risk is something that, you can, I would say, which is not proportionately linked to the market, right? So non-diversifiable where you are linked to the market as well. For example, your EBITDA. So it depends on whether the market is performing, whether the industry is performing, whether the company specific, there is any, let's say, risk regarding to company also. Let's say company is very small. So that could also affect the EBITDA, right? So non-diversifiable is something that is in proportion to the market as well. Diversifiable is only company specific. In this case, let's say milestone based payment can happen, cannot happen, right? So in this case, let's say probability of that event happening is, let's say, 60%. In this case, the only risk that could happen is that the acquirer may not pay, right? Only credit risk could be involved. So that's the reason it is taken as a scenario-based model.
Go ahead.
Can we assume that this entire the assumption is that the management would continue to be in the hands of the acquiring company? The responsibilities are management. Then only
Sorry?
these things will apply. This contingency will apply because it presumes that the entire management and the responsibilities will continue to be with the company which is acquired actually.
That's
Then
correct.
only this-
They could structure it accordingly in the SPA as to what would be the responsibility of both the parties. Let's say the acquirer could agree on certain things and acquiree as well, right?
No, I'm talking about the responsibility actually.
Correct. They could decide the responsibility in SPA itself.
So there is it is like that, I'm only an investor. The entire running of the show is the responsibilities with the company which is being acquired. Then only all these principles will apply. Am I right actually, or I'm wrong?
Not necessarily, I would say, because see, when somebody invests in the company, they will also have a say in the company, right? But they that's one very important step when they're structuring the kind of transactions. They have to decide upfront as to what is going to be the responsibility of the acquirer, what is the responsibility of the acquiree. Let's say if the acquiree is in the management, he is supposed to take all the decision. That could be decided upfront in the SPA. That will not affect the methods that we choose or the contingent consideration.
Well, I'm not talking about the method. I'm only talking about the underlying assumption of the entire thing actually. That the acquiring company will have all the responsibilities to achieve all these milestones, getting FDA approval or
correct. So because it's tied to his, he achieving that milestone, right?
No. So, but the FDA approval and all may be procedural, but earning beyond a particular threshold depends on the business decision. Suppose you want to expand the market, whether you want to spend more on ads or more marketing, or more research, all that will be there. No, but those decisions should be taken by whom? Old management or new management?
No, it depends on how they have structured, right? Now, when they enter into transaction itself, they decide on the responsibility of each of people, right? For example, let's say they have decided that we will take a decision mutually. There is one person from each of the side and, they are taking the decisions, right? It is not necessarily to be in the acquiree's hand. It could be both, because both want to.
Actually, what happens, sir? What happens is I've done a structure like that. When you have done the acquiry, the management has given in, and whenever you have such conditions for earnouts, you have a business plan and the commitments from the people, how much capital, as you asked, advertisement, all put in. And again, of course, there's a board meeting where if things are not working in a particular direction, a decision is taken in the board meeting and put forward all the things. So that is how you write it up. So it need not be that the acquirer is not going to have any decision. He will have a decision, but most of the decisions to be taken to achieve those performance are captured in the business plan, which is annexed as part of the share purchase agreement.
Absolutely, yeah. I agree with that. There is a question in the chat. I think it's from Gautam. Is there anything to keep in mind for a contingent consideration with respect to income tax? Anybody in the audience can answer, because I'm not an income tax expert as such. So, anyone?
tax deal where consideration was dead. We offered it scenarios. You can
Vandana, I think your voice is a little feeble.
we have come across such a situation where the payment was deferred, and the SSC took the initiative and they paid the taxes upfront. But when we discussed with the assessing officer, what the feeling that we got was if the taxes were paid at the time of receipt of the consideration, it would have been offered, but we were just being cautious. So I guess both ways it's possible. Could you please explain? I know the meaning of the word linear, non-linear, but you know how linear means what? If you know the percentage is fixed, you need not you go for the scenario.
It's a proportionate relationship between your EBITDA and earnout payments. Let's say EBITDA, I wouldn't say EBITDA as such. It is the proportionate relationship between your financial metric and the earnout. Let's say your financial metric is EBITDA. EBITDA is increasing. Your earnout is also increasing in the same proportion as your EBITDA, right? So that is a linear relationship. For example, there are certain transactions we saw wherein there is a threshold that is supposed to be met, right? Till then, your relationship is non-linear, right? Because you're not paid anything. It's not proportionately increasing with the EBITDA. But after that, there is a linear relationship. If you see with the EBITDA increase, there is an increase in your earnout.
Non-linear will be when there is a cap or something.
There are cap. If you see capped call option is one of the structure that they do as well. Wherein if there is a cap again, the linear structure ends there, right? There is no linear relationship between them.
Bharti, again, FDA approval in one of the example is a non-linear and non-diversifiable, right?
Correct. Non-diversifiable and it's non-linear.
Because it is something, FDA approval is something irrelevant.
Correct. It's a fixed payment. It is not depending on your underlying metric as such, right?
But actually, it is not a financial metric. So,
correct. That's what. It's not non-linear. There is no correlation with your metric is what I'm trying to say.
Yeah, go ahead, Bharti.
Sure. So I have a question for the audience as well. Let's say there is an escrow account, right? So in case if there is any amount that is sitting in an escrow account, whether it will be treated as a contingent consideration or not.
I think so it is a contingent consideration because escrow account, any amount in escrow account is released upon fulfillment of certain criteria.
Okay. That's correct. In case if the escrow account is, let's say, tied up to an event that is supposed to happen in the future, let's say, and in case if that event happens or doesn't happen, in case if the event doesn't happen, the amount should come back to the acquirer. If the, in that cases, it will be treated as a contingent consideration. Let's say there is a specified number of conditions or future event you have agreed upon in the SPA itself, saying, I will place this amount in the escrow account, but after we sign the SPA, you are supposed to meet all this, you are supposed to do all these criteria. In that case, it will be not treated as a contingent consideration. It is a part of a deferred payment. Because it's not tied to certain financial or non-financial metric being met, right?
What about conditions subsequent?
If it is tied to conditions subsequent, which is already agreed upon in the SPA, right? It will not be treated as contingent. It's ideally the deferred consideration. They meet the condition, they'll get the amount, right?
Yeah. So what happens is, suppose conditions subsequent fail and the transaction fails.
Mm-hmm.
So you're saying the entire thing is not contingent consideration, it's just that the transaction has failed.
Correct.
No, the transaction has failed or only consideration is less. It's not a transaction has not failed.
It depends on the terms of the condition.
Terms of condition.
The terms of the condition.
Suppose
Sorry.
the clause is that company should get FDA approval. If the FDA approval comes, the previous promoter will get X amount extra. Suppose if FDA approval does not come, then he'll get the what is agreed consideration. That's it. The
Ravi,
company will run. Company will run as it is.
Sure. Ravi, that would be a contingent consideration, right? In case if it is tied to something, let's say in this case FDA approval, right? That will become a contingent consideration. Conditions subsequent are usually the conditions which are supposed to be, let's say there is income tax clearance that is supposed to be taken. There are some regulatory or non-regulatory kind of approval that is supposed to be taken. So if it is tied to these kind of events, it is not necessarily a contingent consideration.
Got it.
So next question I have is whether if you guys are aware of that, you know, in case of when we are doing a PPA, there is a forecast, right? Forecast should not include any buyer-specific synergy for us to buyer-specific synergy to be taken in the forecast, right? In case of contingent consideration, can we take a buyer-specific synergy in the business forecast?
It is. We are, because it's a participant specific, no?
Correct. So ideally is that this contingent consideration is supposed to be paid later, right? So their acquirer has already come into the company and there is some synergies that he could potentially have with the acquiree. So that is the, you know, in that cases we can take a buyer specific synergy as well in this case. Any other questions?
But does it satisfy India's guidelines of valuation that it has to be a market valuation with unbiased evaluation?
Sorry?
But does it satisfy when we are doing India's valuations? Because in India's valuations, we do the valuation of the entity with market participants.
Correct.
No buyer specific. So now contingent considerations are specifically a participant specific synergies and participant specific value. So which basically that amounts gets reflected in the balance sheet. So year on year, when you're doing the India's valuations to determine the fair value, then we are going to the market participants perspective. So there we are not taking the participant specific synergies any which ways.
Correct.
So it is not a participant specific then.
Sorry, we can ideally take the buyer specific synergy as well in this case, only for the contingent consideration portion when we are doing the fair valuations, right? It's allowed to be taken.
Okay, thank you.
Thank you. Any other questions?
What could be buyer specific synergies?
See, a buyer could have a larger customer base, right? So in case if the acquirer is coming in, he could utilize that larger customer base. Or if there is a cross-selling that is possible, let's say, you know, customer acquirer is selling something, but there is a complementary product that can be sold along with the customer's product. So there are certain synergies that come in when they combine together, right?
So then this becomes the basis for forming a decision of merger or not, right?
I didn't get your question.
If the merger is happening, this becomes the basis for why the merger should happen.
That's correct. See, when we do a PPA, purchase price allocation, we have to do the allocation from the point of view of the date of acquisition. On the date of acquisition, from any market participant's point of view, what is going to be the value is what we are going to determine, right? So we are not allowed to take a buyer-specific synergy in that case. But in case of contingent consideration, because the contingent consideration itself is tied to a future event, there could be certain kind of synergy that could come in after the buyer takes over the company, right? So that is in case of contingent consideration alone, when you are fair valuing it, it is allowed to take a buyer-specific synergy as well. Not for the other consideration when you're doing the other allocation, but for contingent consideration fair valuation, you're allowed.
Okay.
Bharathi,
Sure.
what is the impact of goodwill in case of contingent consideration?
Sorry.
Impact of goodwill in case of
Uh,
contingent consideration.
Correct. Like I said initially only, right? In case if we decide to take the PC contingent consideration within the PC, then it will come under goodwill. Anyways.
I'm asking whether it will increase or decrease in case of contingent consideration.
In case if you decide to take it, it will obviously increase, right? The goodwill will increase, depending on whether it's a goodwill or capital.
Okay, thank you.
Increase, yeah.
Are you covering any method on how to value this or any example? How to
Sorry?
value contingent liability, contingent considerations?
I would. That's the reason I just touched upon the both method, because by itself the scenario-based method has a lot of nuances. For example, we need to see the risk associated with the assets and see the payoffs, etc. For both the methods, let's say to decide whether it's scenario-based method or option pricing method, there is an it requires another entire session. So that's the reason I didn't touch upon the topic. But provided the opportunity is there, I'll definitely take the SBM and OPM model in the next session.
Bharati, one more request.
I have a question, madam.
One minute, Mr. Debashish. Bharati, this session will again be uploaded on YouTube. So
Okay.
if you're comfortable, we can stop the recording, and in case you have any NDA issues within a small group, let me know whenever you feel that any information you would like to share, but just for recording, you please let us know. Accordingly, we will take this, and then let's see. Okay. Yeah, Bharati.
Sure.
Mr. Devashish, go ahead.
Madam, what I was asking is that contingent payment based on getting US FDA approval. Now, I have experience in pharma industry. I know that getting US FDA approval takes a long time, maybe 3 to 4 years. From US, the auditors come, the US FDA department officials come, they do check, they return, they disapprove, then again the process starts again. It is taking, in many cases, the process takes 3 to 4 years. Now, can we attach any probability for this kind of thing for getting US FDA approval? I'm specifically talking of US FDA, not European FDA, because US FDA takes a long time.
That's correct. See, when they structure the deal itself, right? So they can decide, the acquirer and acquiree both will be aware of how much time it is going to, probable time, at least they will be aware, right? Based on that, they can do the structuring as such.
Probable time, can it be fixed? That is my question, because it is actually dependent on the officials from USA, whether
Correct.
they do like it or not. In many cases, I recall that in Ranbaxy, what happened that they discovered one strand of hair only in the formulation process, and they disapproved the entire this application process, and they had to restart again. This kind of thing happens.
Yeah. So when they enter into the transaction itself, they can see, in case typically it takes 3 years or more, they can decide on that time, and in case if they get it earlier, the payment will be done, right? So that is how they can structure it. So it ideally depends on how the structure happens there.
Okay, got it.
Thank you. Any other questions? Shilpa, I think that's all from my side.
Yes, Vijaya, are you there?
Yes, sir. Subra sir, good morning.
Good morning. Who is giving vote of thanks?
Shilpa ma'am, sir.
Yeah.
Bharathi ma'am, just wait, ma'am. Shilpa ma'am will give vote of thanks.
Ms. Bharti, ma'am.
Bharti, can I just ask one more question? Meanwhile, Shilpa joins for vote of thanks. Bharti.
Yeah, sure, Shita.
So Bharti, can you tell me this contingent consideration valuation comes up only in merger, or there are other situations also when such kind of valuations are required?
Ideally, mergers and acquisition, right? When would you pay? This contingent consideration itself is a part of business combination, right?
Okay, so nowhere else we'll find this.
I don't recall. Yeah.
I'll give an example, Bharti. I don't know whether it's contingent consideration, and you can elaborate.
Sure.
There's a company where there has been an investment done by the MNC international investor. The upside to the founder is based on the conversion of the instrument, which is based on various milestones.
Okay.
So when the company had to do Ind AS valuations, those instruments had to be done the fair valuation every year. Now, the instruments fair value is a function of how it will get converted. And that is a function of the performance that is likely to be happening over 5 years, and you do the present value. And depending upon the milestone of achieving minimum IRR, the conversion to the promoter and conversion to the investor, the same instrument will be different. Now, so this is a contingent consideration, or
That's correct.
this is so this is not a mergers and acquisition. This is an investment. Yeah.
Correct. Investment. Let's say, is the requirement for PPA is there in that? If the majority is taken and the remaining is there, then it's a mergers and acquisition. I'm not referring
to the PPA. When you cast a balance sheet from an Ind AS perspective, the instrument is a liability in the books of accounts. And requirement of Ind AS is you have to do a fair value of assets and liabilities year on year. So when you're doing a fair value of the instrument, the underlying terms of the instrument becomes a critical thing, because either whether they will continue to remain as debt or whether they will turn as equity is a function of the performance of the company. And when they convert, the amount, the ratio that it gets converted is a function of how much promoter is going to get and how much investor is going to get.
Okay.
So one, therefore, need not be an M&A. Second, it is a constant revaluation. And in that valuation, when we are doing fair value, Ind AS always says fair value as a market participants. So what it says is, if an individual external investor comes and looks at this particular company along with his assets and liabilities, how he would value that particular liability is what
he can use any of the method actually. See, the method we discussed, OPM, is not only applicable in business combination, right? It can be applied in this situation as well.
Correct.
Depending upon the risk and the payoff, they can decide to apply OPM, etc. Depending on what is the variable factor here.
Correct. Yeah. So I think I just thought I'll share that input in this.
Yeah.
Thank you.
Thank you.
Actually, Bharti, I would like to request you that now, just for some time, I'll be stopping the recording, because I thought if you could show us certain things, it will be more enlightening for us. Are you okay, comfortable, Bharti? Shall I switch off the recording?
Show in the sense,
show us certain reports or certain case law.
That may not be possible, yeah. But definitely, maybe I'll come up with some scenarios wherein we can apply this OPM, and just give me a little time so that I can compile everything and maybe share it with
you. Yes. Sure. Anyone else has any point, or can we conclude for today?
One input I thought I'll share here, Shilpa, if that's okay, is
Yes,
essentially a value. Since we are discussing from valuation perspective, whenever he takes such kind of assignments, okay, either he has been given the clear guidelines of the terms and share purchase agreement, which is the legality. It's a legal document, right? It is required for the valuer, because valuer is not supposed to be knowing all the legal clauses, conditions, etc. Or valuer, when he takes up the assignment, he should very specifically say, I would need legal assistance, either interpreted by the company, then it's an MRL of the company, or he says, I am going to get an assistance of a legal independently, and based on that opinion, I'll do the valuation. Maybe that is required for a valuer, especially when the decisions are based on a legal document.
Absolutely, yeah.
Yes, friends, let's conclude today's session. Can I request Mr. Ganesh Ramani for conveying vote of thanks for today's speaker, Bharathi, on behalf of BVA?
Hello, everyone. First of all, I would like to thank Bharathi. This is a complex topic. This is as good as the intangible assets topic, where nothing is on paper, and it requires lots of reading and assessment. So I think when members were curious to see certain data and certain reports, and I can understand Bharathi saying that, because this is all, she is representing a particular organization. But the nuances of what it takes and how to look at contingent consideration, what comes under contingent consideration, all such details I think have been elaborated by Bharathi, and it definitely gives us makes us go back to look at, especially in today's world when most of the transactions happening in a startup world is all contingent considerations are very much there, and one tends to overlook and apply traditional methods, and she made us to think through that it is not limited to the traditional methods. You need to look at considerations which are not captured today, which are actually deferred ones. I think she answered, and she was all the questions that have come up during the presentation. And thank you so much, Bharathi. And we look forward to the next session with all the examples that you're referring to. Thank you so much.
Thank you so much.
Vijay, can you share your screen for the momento? Bharathi, my special thanks to Unitos and Mr. Vikas Suresh. You have approached him in the last moment, and he has kindly considered, and we are really, in gratitude to you and Mr. Vikas, for this such a complicated topic. Maybe we have not read till now this, as far as I know, I can share about myself. I don't know about other participants, but then BVA is lucky to have, you on today's session and such a complicated topic. On behalf of BVA, we shall be choreographing it this momento as a token of gratitude of BVA. Thank you, everyone. Thanks for attending.
Yeah, thank you so much, Shilpa, for the opportunity to, for giving this opportunity to present and, interact with so many professionals.
It was indeed our pleasure to listen to you, Bharathi.
Yeah, indeed. Same here. Thank you.
Okay, everyone.
Thank you. Thank you, everyone.